This is the 2024 Round Table Prime. It is our fifth version of the Round Table, and we have 5 distinguished guests here today. So let me introduce them in order from my left. We'll start with David Rosenberg from Rosenberg Research. In the middle here, we have Jeffrey Gundlach. He's the CEO here at DoubleLine, and we're welcoming him to his views, and thanks for hosting everyone here at our offices today. To his left, Jim Bianco, another one who has his own name on the firm here, Bianco Research, so he's the president there. To his left, we have Charles Payne, owner of Fox News, is that right? You know, too. So Charles is the host of his own show over at Fox Business. And last but not least, on the end here, we have Danielle DiMartino Booth, who has her own firm, but did not put her name on it, like Mr. Gundlach as well, Quill Intelligence. With that, let's get this party started. So it's 2024. You know, we are supposed to be mired in the deepest recession in the history of mankind, according to the economists last year.
Don't look at me when you say that.
I didn't put you on record here, you know. But I'm going to start with you, David, because ultimately, as we've went through this, we've seen a lot of the economic data, the things that we've used historically and rely on, have been signaling recession for a period of time, whether it's leading economic indicators, it's things like the yield curve. We've seen a lot of things kind of defy gravity here, as some of it's been attributed to the excess savings, to use the Fed's coin phrase out there. Where are we today, Dave?
Well, I think that we are in a completely confused state. And so if you're taking a look at, for example, the national accounts, and we all focus on GDP, because we love GDP, because GDP is about spending, and we love to spend. So real GDP on a year-over-year basis is running at 2.9%. And you'd be thinking, wow, what a great number. But real gross domestic income, GDI, is running at negative 0.2. We have never seen a gap in the national accounts between income and spending that large. And it comes down to what you talked about, which is that the last leg of the excess savings file, remember what happened was that Uncle Sam borrowed money 2 years ago, a couple of $1 trillion to give to the proletariat, and they spent it all. But you see, this was not organic income that was spent. And that's why the savings rate is so depressed. So you've got these wild anomalies. You know, you would look at the employment numbers, and of course, everybody bows down to the holy grail of non-farm payrolls. But what was the household? What did household employment do? The household employment created full-time jobs. Actually, we didn't create any full-time jobs last year. But there's another huge dichotomy, because the payroll survey is showing, say, 1.8% year-over-year employment growth. The household survey is showing 1.2%. And, you know, in a 130 million workforce, you know, 0.6% is not a trivial gap. And out of the 1.8 million jobs that were created, say, in the household survey, because all the fascinating information is in the household survey, out of the 1.8 million, every single one of those jobs was in part-time, self-employment, and people taking on more than one job, which is a classic. I mean, if I showed you the ratio, the share of the employment that is people taking on more than one job, that is a contra-cyclical indicator. That's telling you that there was a lot of stress at the margin in the household sector. So it depends really, you know, what metric you're looking at. I know that Danielle, you know, said many months ago the recession may have already started. If you look at the income accounts in real terms, it's actually telling you that. And there's something else that I'll just say that, very interestingly enough, that was about 3 months ago that Patrick Harker, who at the Philadelphia Fed, so 3 months ago, he comes out and says that the Fed is increasingly going to be watching, listening more closely to their business contacts than the data, okay? You know, look, what was the defining feature of last Friday's payroll number was the negative revisions. We had negative revisions all year long last year. You know when you look cumulatively at the negative revisions and payrolls, it's like 430,000. And because the response rate is so low in this post-COVID world, in fact, the response rates are low for almost all the government data. So here the Fed's telling you that we're putting less weight. Somebody says to me, well, Why are they talking dovishly? Why are they talking about rate cuts? Because look at the data. But you see, not all the data. There's so much non-confirmation in the data, like I said before. But the Fed is paying attention to what business contacts are telling them. And so I instructed my staff. I said, when the beige book came out at the end of November, I said, we're going to tear that thing to shreds. And what did we find out in the Fed's beige book, which is all anecdotal but so rich in information, was that 2/3 of the country, 2/3 of the Federal Reserve districts, there's 12 of them, 2/3 are either contracting or stagnating. So what do I do for fun at the tarmac? To show you what a fun-loving guy I am, I go back and I look at all the previous Fed beige books back to 1970 on the month the recession started, going back to 1970. And the November beige book was more downbeat on the economy than any other one on the month the recession started. So I know there's this glow, and I'm sure the macro bulls have their case, but I think it's a false glow. There is no way you can read that beige book and come to the conclusion that the economy is not already starting an NB defined recession. It hasn't shown up in the data yet, a lot of the data, but then again, this data, like we see with payrolls, will get revised.
So you talked about the labor market and the jobs. Danielle, you gave a handout out to everyone here.
I did. I slipped one in.
You slipped one in, and you told me don't tell anyone until it happens. So now the secret's out. But you have a chart in there that kind of decomposes some of the job growth. Do you want to talk us through that just to start off, because I think it piggybacks on some of the stuff that.
So I'll have that be kind of the punchline, that particular chart, because that's the most recent analysis that we've done of the labor market. And the genesis was a Wall Street Journal editorial, of all things, that a client brought to my attention and said, "Is this math right?" And I'm like, "No, it's worse." But in the month of September, what we saw was, in the month of October, what we saw, the Bureau of Labor Statistics tracks state-level non-farm payrolls, state-level unemployment rates for 50 states plus District of Columbia. So going back to data that dates to 1976, every time you hit the 50-state threshold, the only holdout in the month of October was the state of Texas. But once you hit 50 states, 9 out of 9 times in data back to 1976, you're in recession.
You said 50 states. I missed what you said, 50 states. You hit what in 50 states?
Rising unemployment rate.
Rising unemployment, okay. Yeah.
Rising. So once you hit 50 of the 51, and in October Texas was the only state that still had a falling, and we took this out to 3 digits.
How can the national number not be rising then?
The national number is rising, but remember, it would have been 4.1% last Friday had it not been for the decrease in the labor force participation rate to the magnitude that it was. So it wouldn't have been 3.7 reported, it would have been 4.1. But just to back it up, all 9 times out of 9 times that's happened, the subsequent month, which I think we're going to find out when all these revisions finally, when the dust settles on them, every subsequent month saw the stock market go up for several months, and then it saw non-farm payrolls turn negative and the unemployment rate rise. And we were always in recession after that threshold was crossed. So we said, this is strange, but I think they're going to backdate it. I think the NBER is going to backdate it to October of 2023. And it's fun. I've gotten to know Anna Wong at Bloomberg. She's an economist there. She looks at the data through a slightly different prism. Same conclusion is October. So I think we're going to get there after revisions. Speaking of revisions, so the month of July, if you're looking inside the BLS website, the month of July actually has a positive number by it of positive 40,000 revisions for the month. But once you incorporate that 99,000 of those positive revisions were government jobs, what we saw was an average of 48,000 per month, average negative revision in the year of 2023. The last time we had this was 2008. It was negative 65,000 per month. So that kind of is the second signpost. And then a client brought to my attention this Wall Street Journal editorial that said 125% of the jobs in the state of New York have been created in government assistance, social assistance, government jobs, and healthcare to house this massive growth in the welfare state, meaning net 20% of the jobs in the private sector were negative. And there were 3 states, Illinois, New York, and there was a third state in that. But what you're looking at with the upside down, it looks like a food pyramid in front of you, is that once you add leisure and hospitality to that, and I call that a non-productive occupation, once you add leisure and hospitality, you get to 81% of the jobs created in the last 12 months. 81% to non-productive, low-income paying jobs. As far as high-income paying, what we would consider to be white-collar professions, -1%. And that's through December 2023. So it's just an extraordinary environment that we're in. And it helps explain why people keep saying, why, if the unemployment rate's 3.7%, then for heaven's sake, why are household delinquencies so high with the unemployment rate so low? And you fill in the blank with the fact that there's not a lot of income generation right now in the US economy.
Right. Well, we also got the Fed data too recently, and Jeffrey, maybe you want to comment on this too, on how much the household debt exploded last month too. And so I know you've talked about this in the past about, well, we see retail sales and, it looks positive. There's this consumption, and you have the income went up 30 basis points for the month, but spending's up 50% or 50 basis points, and the world celebrates. What are you thinking about in the consumer side? How are you thinking about that and what we've seen in kind of this consumption pattern? And although income levels have been, wages have grown more meaningful than we saw pre-pandemic for the post-GFC era, they're really still not keeping pace with this consumption.
Yeah, we're seeing delinquencies from the consumer going up at a very noticeable rate. And that started happening several months ago. And so we're starting to see credit card delinquencies and other types of consumer borrowing. I think that one of the amazing things is the dichotomy, and I think Rosie brought this up, between the establishment survey and the household survey. And in the most recent month, the establishment survey says that there were 216,000 jobs added. And the household survey was deeply negative. So there's this massive difference between the two. And we talk about jobs growth on the establishment survey every month. But the household survey peaked in April in terms of employment. And there are 2 million fewer jobs now on the household survey. And if you look at the history of this, before the global financial crisis, weirdly, the household survey was generally stronger than the establishment survey. And then ever since about 2010, the household survey is much weaker, and it's getting weaker like all the time now. And the gap is getting very, very large. And I'm wondering why market investors are so focused on the establishment survey. When the employment numbers come out first Friday of every month, the market moves immediately on those numbers. And really, most people don't really have the time to dissect it. And then you have a parade of commentators in financial media that talk about the number 5 minutes later. And they don't really have time to go through it and look at it. And so I think that I'm starting to wonder if some of these numbers are even real anymore. One thing that troubles me are these revisions that we've been talking about to the payroll number. I mean, if you want to be a conspiracy theorist, you might posit the idea that they intentionally make up the number so that you can get the press secretary or whoever to tout how strong the jobs market is. And then lo and behold, it gets revised very substantially lower. If I was going to be, diabolical, trying to run for president in 2024, I might just say, announce this 350,000. And I also think that, I don't know, I feel like there's probably going to be deflationary pressure, which is actually good for the consumer, on energy prices. I think there's, nothing makes life easier than people seeing that the gas price is going down. And oil, West Texas Intermediate, is down there at about 70, seems to be where it settles in. And if it goes down, there's a lot of support at about 63. And it's nothing but air down to 40. And I'm starting to get convinced, not fully convinced yet, but I'm starting to get convinced that we're going to go to 40. And maybe that's just on manipulation, on job owning with the other producers, trading partners. we're already producing a lot more than we were a few years ago.
We're an exporter. Yeah.
So that would help the consumer. But certainly, the vast majority of historical indicators suggest that recession is more likely than not, to my eye, in 2024. The one that's obviously still holding up are these so-called employment numbers. Everything else, I mean, the yield curve has been inverted for what now? It's got to be a year and a half almost, and it's de-inverting at pretty good pace now. It got to 108 negative 2s to 10s, and this morning we're down at about 29. So when that de-inverts, that's a really big signal that something's going on, and that's been happening. So it's a long process. One thing I try to remind myself, and I try to impart this experience on others, when it comes to the markets and the macroeconomic factors that drive it, you can get a sense of what's coming, but it always takes way longer than you think. Like, I remember I turned negative on the housing market in about 2005, and it stayed really strong for a few more years. Everything takes longer than you think, and everything goes further than you think. And so I'm of the opinion that we have to be getting close when you put, the yield curve, you look at ISMs. What's made all of this very tricky, and we've talked about this a lot in our macro meetings, is we had such an odd volatility with M2 and with money giveaways that still linger. I mean, M2 is down, and it was negative year over year all of 2023, but it's still way above trend if you go back to the trend of M2, which was growing at a pretty steady level, and then all of a sudden all that money comes in, and now it's been falling. But at the rate it's been falling during 2023, it'll take more than a year, maybe even 2 years, for the M2 level to get back to that trend line. And I think that has something to do with why this is such a protracted process, and everything takes so much longer. I mean, we had no services in the lockdowns, no restaurants, no lodging, no airfare, and so it was all goods. And so the manufacturing data was really good, and then suddenly weakened a lot. And I think classic macroeconomic trends suggested that, hey, this looks like, leading indicators are -7, and they've been there for a long time, but there's a lot of manufacturing in there. And there was this baton pass from manufacturing to services that I think had a lot to do with why the consensus was wrong. Looking at the M2 being negative, well, if that's true, that's negative. It's just like inflation is down, but prices aren't down. M2 is down, but it's still elevated versus trend basis. And so all these things are hanging around. But I do notice that there's starting to be a little bit of light coming. The dawn of enlightenment seems to be building. I saw a story today that Anthony Fauci admits that the 6-foot distancing rule was just pulled out of the sky. There was zero scientific reason for it.
It wasn't the sky.
But that there was literally, was just arbitrarily determined. And so maybe people are waking up to that. The other thing that on the payroll side, we had this moment of humanitarianism in 2020, 2021, where you didn't have to pay your student loan, you didn't have to pay your rent, nobody wanted to fire anybody. Everyone was, being humanitarian.
It ended in July in California, by the way, of 2023.
Yeah, and then suddenly you have to pay your student loan back. And I predicted that when they turned back the faucet on for student loans, I predicted that 40% wouldn't pay it. And my gut was exactly right. I mean, 40% are not paying it. And now we're starting to see less humanitarianism. So you have to pay your student loan, you might have to pay your rent. And now we're starting to see the beginning of layoffs. BlackRock this week announced laying off 3% of its workforce. I think you're getting to a point where, and this is the tipping point, I think, of the economy, in my experience, is you get to a point where it's okay to lay people off because everybody else is doing it. It's like the supply chain thing. If you had bad earnings, it's the supply chain. Everybody's got the supply chain problem. You just blame it on that. And I think that it will be one of the themes of 2024 will be layoffs, and I think that's obviously sort of the end of the game. So I'm not sure I answered your question, but those are kind of my broad comments.
Yeah. Charles, you've been a little bit more constructive than what we've heard thus far. Maybe you can give us a little bit of your outlook. What are you looking for the economy in 2024? And kind of what are some of those kind of pain points that could derail that?
Well, I have my own research firm as well. It's called Wall Street Strategies, and I've been doing it for over three decades. And on one hand, you have to make people money. On the other hand, we talk about these realities that aren't necessarily expressed in the market or the way we see it. I think first and foremost was all the money that cascaded into this economy. I've had the opportunity to interview the top economists on Wall Street, and I didn't see very few. Anytime I really wanted clarity, I'll look at Rosie's work, Jim's work, and Danielle's work, or do it myself, right? I mean, for instance, you're spot on, Jeff, when it comes to the reporting part of this. And I don't want to sound too conspiratorial, but first I think the fix begins with the Wall Street's consensus. It's always like a number that's kind of lowish. And, we beat Wall Street's consensus, the economy is strong. That doesn't mean the economy is strong, right? I mean, it's so... I'm sitting there last Friday. I think the jobs number came out last Friday. Yep. I'm on a panel, and everyone starts to regurgitate. The economy is strong. The economy is strong. So I'm going through it. I'm like, well, can we be strong when 680,000 fewer people are working? Wait a minute. Hold on. Can we be strong when 640,000 people drop out the labor force? Is that the definition of a strong economy? But regurgitate. Then you've got the headlines, then the algorithms go to work. Stocks go up, bond yields go down, but by the close, that stuff kind of fixes itself a little bit, but it happens every single day. And by the way, great work out from the National Bureau of Economic Research in December on just these macroeconomic news events, how much more impactful they are versus just good old-fashioned fundamental research. That's why so many people are so frustrated. I think 44 events a year contribute 71% of the market moves. And if it's always good at first, then you have a year like last year when everyone thought it was going to be down, it's up. And when it gets revised, the revision is right next to the obituaries when you look in the paper. Right? It's like, there's a real number. Yeah. I didn't know Pete died. I thought he was already dead. So, it's like one of those things, right? And so it is so upside down, it is so skewed, and it feels like, the fix is in and everybody's in on it. And the thing for the analysts kind of goes back, I think, even back to the Wall Street crash, and when the analysts were really de facto salesmen, and I think they've always that's why you've always had the whisper number, right? And because there's always what we officially said, and then it was what we really thought when we spoke to each other, behind closed doors. And I agree with Jeff and also Rosie in the sense that I just think a lot of this stuff is delayed. I just don't think proper adjustments were made to these models. Mm-hmm. You can't account for $2 trillion. You can't account when people don't have to pay. The average kid out there, not really a kid, right? Let's say the average person with a college loan who didn't pay it back, not only do they owe on that college loan, but their credit card bill is more. Remember Nancy Pelosi during when Obama was in office, they had this big argument, a big fight about increasing the food stamps. And she said her main rationale for it was a multiplier effect. If you give people $1.50, they'll go out and spend $2, sort of to speak. When people got these stimmy checks, they didn't just spend $1,400. I mean, how could you give away $2 trillion in credit card bills went up? How could you do that? Because we understand. And last January, February, Stanford put out an amazing piece on how all of this money will end up with the top 1% over the next 5 years. And this is what frustrates me with economists who come on and say, well, the households are doing great. Yeah, the bucket is doing great, but this part of the bucket is empty, right? So they've taken all the excess cash and they move it along. It's a propensity to consume. 40% of us Americans have to spend it right away. They never had that kind of money. They spend it right away. Then it moves to this part in the middle of the part of the bucket. Now the bucket weight is the same. Then it eventually moves to this part of the bucket. So the economists come on and say, I weighed the bucket. It's great. It's hanging in there. It's phenomenal. And everyone's like, yeah, it is. And the market goes up and everyone feels good. I got to make money in that environment, even though I know it's kind of BS. And so it's a tough act because it's when you have to try to make people money, or at least make sure they don't lose a lot of money. versus like, wow, something is really terribly wrong here. And again, I see it every single day. I feel like the fix is in. Even this morning when the inflation data came out, everyone is rationalizing it's not a bit. If it had been a little bit less than anticipated, it would have been the biggest story out there. Instead, they're talking about Belichick, right? I mean, come on now. You know, this wouldn't have been the topic du jour, if the number had come out better than expected. So I think the impact of these macroeconomic events and data is just so overwhelming. You couple that with the fact that there's 4,000 publicly traded companies, used to be 8,000. You couple that with the fact there used to be 350 billion shares out there, now there's 300 billion. And it doesn't take a lot to move these stocks. Particularly in the M2 thing, I think was a great observation because, again, it's not back to trend, but I think what's even offset this crazy drop in M2, velocity of money. No one really talks about that, but going back to the 1990s, the velocity of money in our country went straight down. I lived this, by the way, real quick, I don't want to hog up all the time, but when I was growing up in Harlem in the 70s, our neighborhood, we used to have these community meetings and people would be upset. We didn't have these brand name stores in our neighborhood, right? But what we have, we go to 125th Street where the Apollo Theater is, and rows of people with benches. And they would be selling things, selling Blue Jeans. And then they take the money and go across the street to the guy selling records at the record store. Then that person would take the money and go to the restaurant across the street. The circulation of money, the velocity of money stayed in the community. But they were crazy, they were begging. We want these big chains to come in. Okay, here comes H&M. You give them your money and they send it over to Europe. No velocity of money, no velocity. And I think it's gotten a lot worse with the internet. But because there was so much money that cascaded into this economy, we actually had a major spike in velocity of money recently. And I think to a degree that's offset the decline in M2. But all of that's going to fade away. And I tend to think that at some point it's going to be shocking, but we're going to fall off some sort of a cliff. So we have to be prepared for that.
Yeah, I mean, let the money circulate, right?
Let it circulate,
you, right?
Let it touch a few hands before before Jeff gets it all.
Yeah.
No, the IRS gets it all.
Yeah, we have this thing in California called the Franchise Tax Board. They get their cut.
Yeah.
14.4 now.
So, Jim, you probably have the more more aggressive view on inflation of what I'm hearing around the table here. Maybe you could tell us a little bit about how you get there, what you're thinking about inflation, and why you don't think deflation's on the horizon.
So let me start with two things from what I've heard. First of all, I agree with Rosie that the response rate to surveys, first of all, a lot of the economy that we measure is measured from surveys, whether it's the payroll survey or it's a survey of purchasing managers. Our opinions about politicians come from surveys. And the response rate to surveys is collapsing. No one answers these surveys. My theory on it is not unique, it's because we have social media. We get to vomit our opinion all over social media, so when Gallup calls me or the BLS calls me, I don't get all excited. Somebody wants to know what I think.
Doesn't it show up as spam on your phone anyway?
Yeah,
Isn't that what part of it?
Yeah, it shows up as spam anyway because I've already done it on Twitter or something like that. The payroll survey, the establishment survey of businesses was 49.4%, which equaled a 33-year low in December. So that means that the BLS has to guess what the other 50.6 was. And over the next 2 months, they go back to these people and they say, please answer the survey. And they try and get it up into the 80%. And then we'll see what the difference is between their guess and what they get resulted in. And that's why you see all these revisions going lower, because they're overly optimistic on their guess. And they've got a bigger pie that they have to guess on. And that's why we've seen it. Now, what's happening there, I'll give you one other statistic too. So the Conference Board puts out the leading economic indicators index. It's 10 indicators that they've put together in a model and that they think tells us where the economy is going to go. They used from 1960 to 2020 as their period that they've put this together. And what we've seen in the last 2 years is we've seen 20 consecutive months of this indicator declining. In history, The longest we've ever seen it go without us being in a recession was 9 months by January of 2008. And the average is 6 is when we're in a recession. So this model's already completely wrong. The recession
jump
is
in 1
supposed,
second?
yeah.
Because I interviewed Dana Peterson recently. She's the chief economist at the Conference Board, and she admitted on air that there's faults with it. I was shocked that she would admit it. I said a lot of people are pushing back, and she admitted. So
Right.
I wouldn't be surprised if they have to go back and retool that.
But that's, there's a UK statistician, George Box, who famously said, all models are wrong, but some are useful. And so it's kind of useful that this thing has been wrong because it gets to the second point I want to bring up. Every so often we have an economic cycle and it changes things. 2008, 2001, 9/11, the 87 crash. And I would argue the bigger one of all of those was 2020. That coming out of 2020, a lot of things changed, and I would argue maybe permanently or at least for the rest of our life. And by the way, change does not mean dystopian. It means different. The biggest example is remote work. Remote work has changed the culture of our country, good or bad, depending on what chair you sit in. And because of that, I think that we've got these fundamental misreads of the economy. I think that on balance, the way that I've been viewing it is the workforce has a fundamentally different view about work. They're not so stressed about it anymore. I have a job, I get a paycheck, and as long as that keeps coming in, I spend, and that's what we've been seeing. What if I lose my job? I'll find another one. And so because of that, you started to see some changes in behavior. Prior to 2020, when the stock market rallied big and your Zillow estimate of your house went up, you would look at it and go, oh, I have more net worth. I have higher savings. What are you going to do with it? Feel better. That's what I'm going to do with it. I'm going to feel better. I got more savings. I got a bigger cushion in case of a downfall. Then in 2021 and 2020, when we were getting money in from the government, what did we do with it? Meme stocks, Dave Portnoy's picking letters out of a Scrabble bag to try and figure out what he's going to invest it in. We're going to go to the Bahamas. We're going to go to Florida because it's open. We're going to spend it. And so now all of a sudden, we're a lot more aggressive with that money. So when I see my brokerage statement come in and it's up big, I turn to my spouse and say, let's go to the Bahamas. I don't say, hey, we've got a little more of a cushion in case things go bad. So the attitude has changed. Now, maybe that attitude has changed because they mailed me money and they'll mail me money again on the next downturn. But whatever, I think that attitude has changed. And if that attitude is leading towards more spending, that's more demand. And what I'm concerned about is that the inflation rate is going to stay, and I'm careful on this word, sticky. Sticky means 3%, 4%. Sticky does not mean 8 or 10 or Zimbabwe. It just means it's going to be a little bit higher. If it stays sticky, that's going to frustrate the idea that the Fed could pivot, they could cut rates, everything will be okay, and that we're going to start to see, I think, a disappointment come in with the data in 2024 in that it won't show that last mile that we like to talk about with inflation going all the way down to 2%, allowing people to have these views. We might be faced with either a stagflationary environment where the economy weakens but the inflation rate doesn't, or a little bit like last year, because remember a year ago the consensus was recession. Now the consensus is soft landing, that we wind up upside surprising again with the economy. So I've started with the premise, things changed in 2020. Remote work is probably the most visible one. Deglobalization is definitely accelerated. It existed before. Google is making the Pixel phone in India. Apple wants to move the iPhone assembly to India. They want to get away from China. Taiwan Semi's talking about potentially building fab plants in Arizona and Ohio. They want to try and bring stuff back here. It's more expensive. Why didn't they do it before? Because the pursuit of globalization was find the cheapest place in the world to do it. But now we're either factoring in political risk or some other kind of risk, and we're saying it's worth it to spend more to do it in India or in the United States because it's a more stable place to do it, which also then corresponds with you're going to have a higher price for that product.
Okay, so you're leading us into the Fed, so I'm going to start with you, Danielle, on this too. There's been a big change in the rhetoric that's come out of the Fed in the last couple of press conferences, starting November. We're calling it a pivot again. It seems like Powell seems to be leaning towards it. It was higher for longer at the previous one. Financial conditions are super tight because the bond vigilantes are here. To no, maybe it needs to be weaker. Maybe we're late in the cycle. Then it pretty much sounded like, hey, we don't need to get to 2, as Jim's talking about, to cut that last mile. What do you think about Fed policy? What's being connoted here? Market is obviously bitten into the narrative, right? We have over 5 cuts priced in, or at least let's call it 125 basis points of cuts
I
priced in.
I think there are 5.
Yeah.
As of now.
Where do you land in that spectrum?
I'm of the view that that Jay Powell is the least political Fed chair since Paul Volcker was in office. I think the pivot was undertaken when it was in order to get in front of the Iowa caucuses, because the next Fed meeting is not until January the 31st. So I think he actually wanted to get out in front of the beginning of this political season, truly when it gets started, opening day, Iowa, January 15. What has occurred in Fed communication since then has been nothing short of extraordinary. Jay Powell was not on Team Yellen when it came to manipulating the Fed minutes, and yet they inserted that they're thinking about tapering quantitative tightening. They put it in the minutes.
Right.
There was no mention of it at the podium. There wasn't even a hint to it. There was no, we're going to maintain our balance sheet policy. Something has spooked.
And the market liked that, by the way.
Oh
when
my
those
gosh,
minutes
are you
came
kidding
out.
me? Because that's what the market wants next. And now you have this unusual situation where you have John Williams, his second lieutenant after Christopher Waller, butting heads with his former head of markets desk, Lori Logan. Lori's saying it could be imminent. Williams is saying, I don't think so. And then you get this inflation report out this morning. And it's just like the JOLTS reports were last year. I'm of the view that Jay Powell wants to continue killing the Fed put, and that just because he changed the narrative and verbally pivoted does not mean that he's not going to continue to hide behind data that he doesn't even believe. I think he wants to continue to roll off the balance sheet. I think that there's an odd chance that rather than 15 to 20 billion a month in mortgage-backed securities roll off, you actually end up seeing something closer to 25 billion as refinancing prepayment speeds pick up a little bit. And they might start to talk about tapering the Treasury aspect of the quantitative tightening as the reverse repo facility is depleted. I don't think that they're going to let it get past 100, 200 billion, which, I mean, UBS, I mean, everybody's got a different estimate, but most people are pegging it at the end of Q1. And the end of Q1 is also when the high yield maturity wall goes live.
So just so everybody understands what you're talking about here too, so you're just saying that the decline in the excess or the reserve repo facility
From $2.5
coming
trillion
down
to 690 something
that's
billion.
considered to be excess liquidity in the market, and therefore that declining says that there's going to be pressure in the marketplace, and therefore the market can't absorb the QT.
In theory.
Right.
So your QT multiplier, if you will, every dollar of quantitative tightening, you see other deposits and liabilities come out of the banking system at a multiplier of 1.5. In theory, that multiplier is going to go up after the reverse repo facility. And I call it a shock absorber. It's like you're driving down a really awful highway and it's full of potholes. Well, when the reverse repo facility was $2.5 trillion, your shock absorbers were really thick.
Yep.
And now it's a lot thinner. So you can actually have more of an impact of depleting this liquidity from the system. But Jay Powell does not like Donald Trump. But it's a hard foot race because he doesn't like Joe Biden either. He doesn't like either of them. And I don't think he wants to be perceived. I can't remember the last time I read that a Fed meeting was going to end on a Thursday. But that's the case on November the 7th. because they're not even going to meet on the Tuesday that is election day. They're going to meet the following Wednesday, and the statement's going to come out on the Thursday. If you look back at history, in theory, that means that the meeting before the election is September the 18th. Now, Jim knows his history pretty well when it comes to this. It's a toss-up when you look back at history. Do they make a move at that last meeting before election day or not? I don't know. But it's not necessarily because he's not worried about the economy slowing down. Something has spooked him. And I'm not going to pretend to tell you that I know what it is, but something spooked him enough to put the Logan plan into effect.
I'm going to let Rosie jump on what he thinks spooked Jay Powell, but you said that Powell doesn't like either of those two candidates.
He doesn't like either candidate.
Yeah, I think there was a survey out that said that
true of a lot of people.
do people want these two candidates? It was like it was 80% disapproval to that. So I
But
don't think
mean,
he's
but he
alone on
is-
that
but,
either.
But we have to bear in mind, he is laser focused on Basel III Endgame. So Basel III Endgame, if you have insomnia, Google it. Read the fine print. He is focused on his legacy, and his legacy can be one of severing the ties that bind Jamie Dimon's 3/4 of his business is capital markets, because the banks, they facilitate the non-banks. It's their business. It's their bread and butter. It's why central clearing of treasuries quietly on the Wednesday of the FOMC statement got passed, and they're going to move forward with that. Jay Powell and Michael Barr are focused on the plumbing of the financial system, and if his legacy in May of 2026 is leaving it a lot more difficult for private equity to do business and much more difficult to do securitization. And the funding markets, you want to leverage up treasuries? Fine, own it, put skin in the game. If he can push through Basel III Endgame, they could potentially change the name of the building from Eccles to Powell. And I'm not trying to be a Powell cheerleader. I'm trying to say it's a really tall, steep order. And I think that they're going to give lots of ground in the coming 12 months on capital requirements in order to give that back to the banks, but keep the focus on fixing the plumbing that's made the non-banking sector $250 trillion compared to the conventional banking system, which is $180 trillion.
Okay. Rosie, the question was going to be, market's got 125 of cuts priced in for next year. Where do you see that playing out, and kind of timing of it, and why?
Well, I was never a believer that March was going to be the date where the Fed was going to embark on the rate cutting process. Not this Fed, but I believe that the longer they wait, the more they'll have to do. But they are going to be very cautious, and they seem to have this mentality that they're a little nervous that if they cut rates, we're going to have a resurgence of the 1970s where they cut rates and inflation comes back. I don't share that view. But, once burned, twice shy. So, you have a central bank chairman who was concerned about his legacy because he governed over a 9% inflation rate, albeit for 1 month. So they're going to be cautious. But I think rates, I'm not so concerned about whether it's going to be March or May. We'll just have to basically always play the odds. We've got to play the probabilities. So we have to look at history. So I was saying that after the July meeting, which was the last rate hike, if they wait 5 months and they don't move rates again, then the tightening cycle is done. So let's just say the tightening cycle is done. Because they didn't do anything in December, of course, they pivoted towards a more dovish tilt. But they never go back to raise rates after they've been on hold for 5 months in a tightening cycle, full stop. And then you've got to think about what's the normal lag between last rate hike and first rate cut, and it's 10 months. So I'm just basically being an economic historian saying, you want to play the odds. May, June was what I was always targeting. I was never impressed. I mean, you had one Fed official, Mary Daly, sort of come out and say March could be the date. So one person comes out, everybody says, okay, March will be the date. I doubt that's going to happen. I think that you'd have to have a string of very low inflation numbers by then. That's probably not going to happen by then, or the economy's got to roll off a cliff. Or you have to have a financial accident. For March to happen, low odds. But I think that by the spring, they'll be cutting. And then once again, what do we know? We know that just to eradicate the excess tightening, and this is the one thing, and the most important thing that Powell talked about at the podium at the last meeting, was talking about whether or not have we overshot. Have we overshot? We overshot in terms of stimulus, and we overshot in terms of restraint. And he brought that up sort of as an open question. They haven't done that before. But they already told us, despite all the bright lights out there saying that R-star, the neutral funds rate, has got to go up, they haven't touched it. And the New York Fed, and I'm not going to bow down to John Williams because there's no reason for me to, but the New York Fed actually is saying that R-star is actually more prone to go down than up. Now, I'm just going to say they haven't, despite all of the reasons why R-star should go up, it hasn't gone up. Where's R-star in nominal terms? Where is it? 2.5. 2.5. Just to eliminate the excess restraint and to get to neutral, they got to cut the funds rate 300 basis points. Well, I don't know. That's not in the market, is it? And then if we get a recession, and I think Danielle's right. And I actually will come back to something Jim said, that the leading economic indicator is wrong. How could it be wrong? We just agreed that the incoming economic data are completely flawed. How do we know that the LEI is wrong? And we have an unprecedented gap, which I said at the beginning, between GDI and GDP. But all we talk about is GDP. I'm trying to explain that GDI is actually in a recession. And what we know about history, once again, is that when we get a gap between GDI and GDP, by the way, never been this acute. Guess what? GDP in the revisions converge on GDI, not the other way around. So I would say, you know what, LEI's been wrong, down 20 months, not so fast, not so fast. It may still end up being right. So the major point is that if we get a recession, and I don't believe that Mother Nature died, and I don't believe that the business cycle has been repealed. And I believe that the lags this cycle have been longer, just as they were when I was viewed as a clown and an idiot at Merrill in 06 and 07. Where's this recession already? In 08, oops. And back then, as Jeff had mentioned, what kept the Energizer Bunny going were different acronyms than FOMO and TINA. It was MU. Do you remember MU? I know you'll remember it. Mortgage equity withdrawal, cash flow refinancings. Up until the end, up until December of 07, they were drawing down as much as they could and their home equity lines of credit until they couldn't any longer. So this time around, damn right, the excess savings file was something I completely underestimated, okay? The bright lights that are advising Joe Biden said in the spring of 2021, go big or go home. So all the research showed that when the proletariat is confronted with a stimulus check, they save half and they spend half. So we want $1 trillion of stimulus. We got to go 2 trillion. 2 trillion in one fell swoop. You know what that is, right? 13% of GDP. And that was the gift that kept on giving, because today's narcissist, revenge spending, anger spending, YOLO spending. Who ever heard of this crap before? And so all of it got spent. All of it got spent. Yeah, okay. Oh, so the recession has been delayed, not derailed. I hear it all the time, because the recession, and all these Wall Street economists threw in the recession because it hasn't happened yet. Oh, the recession hasn't happened yet, therefore it's not going to happen, is like me saying in Toronto, you know what, it didn't snow in December, therefore, you know what, we're going to call winter off. Who does that? I mean, come on, it's ridiculous. The business...
Canadians do that, apparently.
Yeah.
It's going to be 25 degrees, snow, and 30-mile-an-hour winds.
In any event, in recessions, okay, in recessions, here's what happens. And even in the 1970s, we had 3 recessions. Inflation went down. Interest rates went down. Even in the god-awful Archie Bunker 1970s, in recessions, inflation goes down, because inflation has a huge cyclical element. And Jim and I can talk about the structural issues, deglobalization, but the reality is that demand contracts in a recession and companies lose pricing power, inflation goes down, and historically the Fed cuts the funds rate 500 basis points. So could we go, if Danielle is right on the recession, we're going back towards the zero bound. I know people are thinking, no, that's not going to happen. They said that the last 3 cycles. And so I think we either go to the zero bound, if we luck out and we get this elongated soft landing, then the soft landing will be soft enough to take inflation down sufficiently, in my opinion. We can talk about that later. So I think that the funds rate is going down, and I'd say in the next 2 years, Okay, it's not going to happen all at once unless we get a financial accident, but it's going to be between 300 and 500 basis points. Okay,
Of cumulative easing.
I think we're going to zero bound to 2.5 by the time the cycle is over on the funds rate.
So, Jeffrey, you were going to say something, but to append onto that too, given where policy is, we're like midpoint's 5 3/8, right, on Fed funds. Inflation, we're sub 4 today, right? It's like 3.9 on headline, or on core at least. The headline's 3.4. Should the Fed cut at this point? Should we get back to a zero real rate?
I think should the Fed cut thing is really focused on something that most people haven't spent enough time looking at, and it's called arithmetic. We were able to borrow all this money because interest rates were at zero. If you have interest rates at zero and you can, at least if you have a perpetual, you can borrow infinite amount of money. And then something happened. We dumped these trillions of dollars into the economy. And I've been giving speeches for 20 years saying, I reject the argument that you cannot get inflation in the United States. There was all these arguments about demographics and all this stuff. And I said, I can get inflation by 5 o'clock this afternoon. I can. We'll have the Treasury Department announce that they're going to wire $1 billion to every single American, legal or illegal.
We almost did that a few years ago.
Well, that's what I'm
Even like
getting
it through
to.
California.
So if you didn't see inflation by 5 o'clock in the afternoon, the lines at the Ferrari dealers would be something to behold. All right. So back in the global financial crisis, we sent $100, $200 or something. I didn't get it, but because I was in this too high of a percentage.
It was George Bush, yeah. It was the Bush administration.
It was enough to buy a tie. And of course, that wasn't enough to cause inflation. But the trillions were enough. And everybody amazingly forgot that inflation is a monetary phenomena. And all of a sudden, the inflation rate isn't at 2, it's not 3, 4, it's at 9.1, albeit for a month, right? And so now you have to fight this inflation because everyone's getting pissed off that eggs are $10 for a dozen and gas is going up. And so you got to raise these interest rates. And so suddenly they're not zero anymore. Historically, for decades, understandably, when you have low employment, you have a low deficit. Makes sense. You have a lot of tax receipts. And then when you have unemployment go up, you get a deficit. And that's because the tax receipts go down and the entitlement programs, Social Security, unemployment benefits, all that go up. That stopped in 2015. It stopped. We had low unemployment with that huge gyration with the lockdown, but before 2020 and presently, we have below 4% unemployment, and yet the deficit has been going up. And it's been going up because of higher interest rates, partially. $17 trillion of Treasury bonds come due in the next 36 months. The average interest rate on them is well below where interest rates are today. A lot of them are at 50 basis points. And if you have to reinvest, if you have to reissue them at 4%, you've got an arithmetic problem. I think one of the reasons, and I'm being largely facetious, but not entirely, that we had to pivot November 1st is that I gave a talk at Grant's 40th interest rate conference on October 3rd, before that meeting, and I ran through the arithmetic that we're looking at here. If we have, particularly if we have a recession. So we're running, in good times, we're running a deficit that is over 6% of GDP. So one way to look at it, if we had balanced the budget a year ago, nominal GDP, forget real, nominal GDP would be negative. So it's all debt. Mm-hmm. Now, in recessions, going back to 1969, the average increase in the deficit is about 5% of GDP. The last 3 recessions have gotten sequentially worse. You might want to discount 2020 because of the very unusual circumstances. But the GFC, the deficit increased by 9% of GDP. So we're running 6% of GDP plus, and there's every reason to believe in a recession we could go to 12% of GDP. And that's not even being conservative. It could be worse than that. Well, if we go to 12% GDP, and this is the real kicker, if we go to 12% of GDP deficit and stay there, which is a big if, it might not happen, the tax receipts, the interest expense as a percentage of tax receipts, if interest rates are at 6, so that's an assumption as well, will go to 80%. 80% of tax receipts will go to interest expense. That's impossible. That cannot happen. So one thing that Jay Powell should be thinking about is maybe we shouldn't be so dogmatic about the inflation target. Maybe we got to worry about solvency of the entire financial system. Because I know some of these assumptions can be challenged and so forth, but we're already in that sort of a place. And today, the deficit for December was announced, and it's something like 42% higher than a year ago. And even on CNBC, they said, well, that's partly because interest rates are higher. Mm-hmm. So higher for longer means bankruptcy of the financial system. Higher for longer also means massive problems for the banking system. Because as we saw with SVB, which is a particularly egregious case, they have investment portfolios that are kicking off 3%. Well, if you have a 5 3/8 Fed funds rate, you're losing money every second of every minute of every hour of every day, weekends and holidays included. And the bank's earnings, in my opinion, that will be announced for the fourth quarter are going to be a disaster because of the rising delinquencies, charge-offs, and this interest shortfall situation. So when you create an untenable situation of zero interest rates and you live with it for years and years and years, you got yourself in a box. And that's where we are. And so we're going to have to restructure our liabilities. That, I think, is the story of the next 5 years.
How do we do that?
You have to means test and age-base Social Security. Mm-hmm. You can fix the entitlement problem very easily, but it takes guts. You know, this country has more unfunded liabilities than it has assets. More unfunded liabilities than assets. $217 trillion of unfunded liabilities and about $190 trillion of assets, corporate, household, and so forth. So we're a hedge fund that is, and I've been in this position, thank God I got through it, where you're hoping, please don't call me with the margin call. No margin call. And I actually had one, I was terrified. I was like, wait till 5 o'clock New York, wait till 5 o'clock New York. And the margin call didn't come. But that's the situation that we're in. So what we have to do is we have to decrease the unfunded liabilities. How do you do that? Well, you eliminate, I won't get Social Security, I don't care. My grandfather was so against this government cradle to grave stuff that when he got Social Security, he refused to cash the check. And he was poor. I'm talking lower middle class. Wouldn't cash a Social Security check because he thought it was immoral. That's what we got to get to, a place where people actually take care of themselves and take responsibility. But we're going to have to means test. We're going to have to raise the age. It's easy. I can fix Social Security so easily, and it's not that painful. You just say, look, if you're above X, because people arrange their lives around this check, you can't just pull it away from them and make them go homeless. So you say if you're above X, and let's say X is 50, I'm not advocating for that, but let's just use that. Okay, you're good. But then for every year that you're less than 50, your age goes up by, I don't know, 4 months or something on when you get it. Yeah. And you finally get it up to something like 75, because when FDR put in Social Security, life expectancy was 62. Now, of course, there was more infant death and stuff, so there's a mix shift. But you got Social Security at 65. Now, life expectancy is declining thanks to suicide and opioids and stuff like that, but it's still in the upper 70s. So it's 65. It doesn't make any sense. So, and you're also going to have to do something creative with the debt. What's creative mean? Well, in the global financial crisis, prospectuses were written that mortgages underneath pooled mortgage securities cannot be modified. It cannot happen. But they did it, so they changed the rules. A lot of us were mad about that because we were counting on the prospectus. I mean, last time I checked, this prospectus is supposed to matter. So what do? I'll tell you what you do. You say the outstanding Treasury debt, which has an average interest rate of 3.2, which is obviously going higher if we have rates where we are. You say, you know what? It's 1. We're adjusting the coupon to 1, or to 0.1, or to 0.01. Now that's going to be a disaster for future borrowing. Good. We'll stop borrowing.
All right.
Stop borrowing. So that's my soapbox.
We'd even get a nice leap forward if we just let the tax cut sunset in 2025. That would be a good starting place.
Yeah. I know, Jim, you wanted to come in there, comment on that too. You signaled to me, but we were talking on the desk about this too. And I think one of the biggest kind of scams of Social Security is that it was sold to people as, this is your money. You pay into Social Security. So Danielle, it is earmarked for you. That is your money. Where it's just a pay-as-you-go scheme. And I call it a scheme because it kind of rhymes with
The
it sounds like a
trustees
scam.
of Social Security themselves admit, using CBO assumptions, which are absurd because they assume deficits less than we have today, interest rates lower than they are today, and no recession ever. They say Social Security will be broke by 2032, and Medicare will be broke by 2030. Of course, there's going to be a recession. Of course, interest rates are higher than what they're assuming presently. They might come down. They might be engineered down for that reason. Of course, the deficit is higher than they're assuming. So I'm going to say 2032 is further away than reality. I'm going to say, I'm going to pick a number, 2027. And it's not, when I started in this business, it was, we got a problem with all these unfunded liabilities. Oh, well, but that's going to be 2050. That was back in 1980. And then we got to 1990 and it was 2040. So 10 years pass, it gets pulled 10 years forward. And then it goes, it gets closer and closer. Now it's 5 years from now. It's not our grandchildren's problem. It's not our children's problem. It's our frickin' problem.
Yeah.
But the problem, though, is the exact opposite is being promoted in this country, modern monetary theory.
That left the building once the 9.1 inflation showed up.
Oh, don't you think
that was a hiccup. That's why you didn't. Right, exactly.
Oh,
No
yeah.
one talked about it in those terms, but this is. I think the student loan thing represents this a big time.
No doubt.
The most blessed people in the world are people who typically graduate with a degree from an American university. They live longer. Their children don't experience the kind of crime or poverty. They live healthier. They're the most blessed people on the planet. If somehow they deserve to be bailed out, that's modern monetary theory in a different way. And the political, of course, at 9% inflation, no one wanted to kind of talk about
What I meant by that is the MMT purported that you could print endless money and there'd be no inflation.
Right. And again, that's why no one kind of talked about it. But that is the goal. On the other side, there's a big political movement. That is the goal. And there are a lot of top-notch. I've read, and I may have to one day send Rosie and Danielle questions because I've read some of even Yellen's early work and her husband's early work. I'm like, hold up, these, And by the way, Social Security, Bismarck was the one who came up with the idea of it in Europe to stave off the spread of socialism. We just piggybacked on that. This is a long-term fight, and the political fight behind all of this stuff is the role of government, big government. And the idea that you can print money. And the average person out there, no one bragged about modern monetary theory then, but you brag about the GDP number, you brag about the unemployment rate. There are aspects of this that are still advertised as, hey, if we can, how many cities this year in January started universal income? 40, 50 cities? And every time I read about it, they say it was a success somewhere. And I'm like, no, it wasn't. It was not a success.
Ask Finland.
The border is secure.
Disaster.
So I hear what you're saying, and you mentioned political will. I don't know. I mean, listen, I think a lot of politicians go to D.C. with a certain, they intend to do the right thing. I'm not sure what the draw is, but almost instantly when they get there, they don't want to leave. Almost instantly when they get there, they just do not want to give it up. Maybe we take away their trading privileges, they will. But until then, I mean, look, it's really scary because whatever the proverbial cliff is, wherever that is, and we don't know because we've been talking about it and scared about it for so long. And that's another thing. You know, when President Obama was in office and Republicans talked about the cliff, and everyone was really worried. If you looked at some polls, it started to become a national issue, or people who were sort of apolitical, not even really paying attention to the economy, started thinking about it. But it didn't happen that year. It didn't happen the next year. It didn't happen the next year. And so a decade went by. It didn't happen. So you can't really scare anyone about the fiscal cliff. But what you can do is say, and by the way, think about politicians. They always ask, how do you feel economically? They never ask, how much do you have in a bank? How much debt do you have? How do you feel? Do you feel better? And my greatest fear is that whatever this cliff is, wherever it is and whatever it is, that at some point we're probably going to go over it. I mean, I hear what you're saying about this solutions, but can you sell that to the masses? And I would love to see someone try.
I think you can, because when people finally see it staring them right in the face, they change their behavior. And I think the baby boomers are very docile.
Jeff, right now, if President Biden came out right now and said, listen, I know everyone's going through a tough time, I'd like to send you another $1,400. Fewer people would probably say, okay, I want it, but it would still poll pretty well.
Yeah. Yeah, but
2,000 would poll better.
We come a long way from a chicken in every pot, put it that way, okay?
A man with orange hair once suggested 2,000 was better.
Right, but
he might have been reelected too, but that's the.
So, Charles, a quick comment on what you were talking about with student loans. You are blessed if you get a degree from American University, and I'll put another filter on that. If you get a STEM degree from an American university. A lot of these people that want relief either studied poetry or gender studies, and they got $300,000 in debt for studying.
A lot of PhDs, though, also are going to be getting,
But Jeff, to your question about how do we fix this, let's look at Europe. Every time, France would be a good example. They've really, wherever we are with Social Security and unfunded liabilities, they're probably worse. And every time they try to, increase the retirement age, reduce the benefits, they get the college kids basically rioting in the streets. You're 22 years old, and you're worried that we're going to change the retirement age from 67 to 69, and you go crazy on it. But there is a fix, and the fix was in the fall of 22. Liz Truss was the prime minister in the UK. She proposed what was called the mini budget. That's what they call it there. And it was, we're going to cut taxes, and we're going to increase spending, and we're going to have a bigger deficit. And Parliament looked at her. She's a Tory, a conservative, and Parliament said, we're cool with this, because the Tories were on board, and of course Labour, the left party, is on board with this. But there was a constituency that wasn't in favor of this, and that constituency was the UK gilt market. So in the space of a week, interest rates went up 100 basis points in the 30-year gilt. It not only killed the mini budget because it became untenable to pass it with skyrocketing interest rates, it killed Liz Truss. She only lasted 49 days as the prime minister. Remember the meme of her and a head of lettuce? Which one was going to...
It was like half a Scaramucci or something like that. Yeah.
Right. And now she's
That's actually 7 Scaramucci's.
7 Scaramucci's. Yeah. And she is forever the answer to the trivia question, who was the prime minister when the Queen died? Because it's the only thing that happened in her 49 days. And so the way we're going to get to fixing Social Security, the way we're going to get to fixing the mentality of spending is the bond market is going to fix it. And that is, we are going to take interest rates up and up and up, and you're going to say we can't afford it. And the bond market's going to say, yes, you can. You're going to stop spending, and that's how you're going to afford it, because that's what they did in the UK. They said, you are not going to be able to afford this budget with these higher interest rates, so therefore you are not going to pass this budget. And so that's how we're going to have to get to it, is that wherever that breaking point is, if it's next week or it's 15 years from Thursday or anywhere in between, it's the bond market that's going to stop this. It's the Jim Carville argument that The bond market can scare
It's
everybody.
possible if it's allowed to be free market.
Yeah.
But
So
I'm not convinced it'll be allowed to be free
Then
market.
then we'll have inflation. Then we'll have inflation if we don't allow it to do it.
it's always the solution is in the bond market, right? So
Right.
with that, I think it's a good time to take a break here. That's the start of our macro session. I'm sure we'll bleed in a little bit more in the next section. We're going to cover markets next. So we're going to take a small time out for our audience here in case people need to use the facilities. And for those of you watching on YouTube, you can click on the next episode very shortly.